Every year, the Reserve Bank of India transfers thousands of crores to the government. But this isn't tax money, and the RBI isn't a profit-making company either. So where does this money come from? And why does the central bank give its surplus to the government? In this video, let's unpack the different dimensions of this surplus transfer, how the RBI earns its income, what the economic capital framework is, and how this entire process is governed. What is the economic capital framework? In 2019, the RBI adopted a formal mechanism called the Economic Capital Framework or ECF. This was based on the recommendations of a committee chaired by former RBI Governor Bimal Jalan. The ECF decides how much capital the RBI should set aside to deal with financial risks, mainly through something called the Contingency Risk Buffer or CRB. Only after meeting this requirement can the RBI transfer any surplus to the government. How does RBI earn profits? Now, unlike commercial banks, the RBI doesn't earn from loans or investments in the stock market. It makes money in other ways. First, seigniorage. The profit from printing currency. For example, if a 500 rupees note costs 4 rupees to print, the remaining 496 rupees is seigniorage. Second, interest from lending to banks through instruments like the repo rate. Third, open market operations, where it buys and sells government bonds, earning interest or capital gains. Fourth, foreign exchange management, including gains from managing currency reserves and exchange rate movements. Fifth, interest from foreign assets, such as investments in US Treasury bonds. Sixth, commission on managing government debt, since the RBI handles borrowings on behalf of the government. And finally, it earns fees from services like currency management and banking supervision. How is surplus transferred to the government? The RBI is fully owned by the Government of India, but it doesn't function like a commercial company that pays a dividend to its shareholders. Instead, under Section 47 of the Reserve Bank of India Act 1934, the RBI is required to transfer its surplus. After making provision for bad debts, depreciation, staff funds, and other obligations to the central government. This is usually done in early August after the RBI closes its July to June accounting year. Does the RBI pay tax on these profits? No. The RBI is exempt from paying income tax under Section 48 of the same Act. Its earnings are not taxed under the Income Tax Act 1961. Is there a formal policy for how much is transferred? Interestingly, there is no fixed policy on how much surplus is transferred. A committee led by Y.H. Maligam in 2013 had recommended higher transfers to the government, and since then, the percentage of surplus transfer has sharply increased, from around 53% in 2012-13 to nearly 100% in 2013-14. Earlier, the RBI transferred part of the surplus to the contingency fund to meet unexpected and unforeseen contingencies, and to the Asset Development Fund to cover future risks or internal capital needs. Has there been tension between RBI and government over this? Yes, at times. The government has argued that RBI holds more reserves than required by global standards and suggested using this money to recapitalize public sector banks. The RBI, however, has preferred to be cautious, especially to prepare for financial shocks and maintain its independence. As former Governor D. Subbarao once said, the final amount is usually settled with both sides showing flexibility. What do other countries do? Globally, surplus transfer practices vary. In the UK and US, central banks consult with their respective governments. In Japan, the government takes the final call, and most countries, on average, transfer a surplus equivalent to about 0.5% of their GDP. So the RBI surplus transfer isn't just an accounting exercise. It reflects a delicate balance between fiscal needs and financial stability. And behind every rupee transferred lies a framework of risk management, law, and negotiation.